Hello, and welcome to our latest portfolio update. It's been an interesting start to the year to say the least, with politics very much at play in markets once again. But in spite of all the noise, our portfolios have proven remarkably resilient. The question now is, where do we go from here? And how are we currently positioned? Looking forward, there are three key themes that we expect markets to focus on over the next 6 to 12 months. It's around these three trends that we are currently positioning portfolios. The first of those themes continues to be navigating some risks. Going into 2026, we trimmed our stock market holdings, having identified a more uncertain geopolitical environment. This proved to be the right decision and helped portfolios deliver that resilience during the volatility we've seen in recent months. However, from here, there's much to be optimistic about. Our macro indicators signal that the global economy is strong, particularly in the US. Corporate profits also remain strong, and government spending is supportive. That said, it's not all good news. Geopolitical risk remains elevated, and the likelihood of an uptick in inflation has clearly increased. If we bring all that together, on balance, we believe that the risk environment has improved, and we've taken the recent choppiness as an opportunity to add back to our stock market exposure. However, we've also opened some positions to steady the portfolios against that aforementioned inflation and geopolitical risk. Most notably, we've added to inflation-linked bonds, and we continue to hold that gold exposure, given its ability to support portfolios during periods of uncertainty. The second theme is searching for value. The stock market has been on a strong run over the past couple of years. However, most of the returns have actually been concentrated in a handful of companies. Going forward, we expect the rest of the market to begin catching up. In our view, this is the right time to tilt portfolios into those cheaper companies within the stock market. To this end, we've introduced a US value exposure and added a holding in infrastructure. Both provide access to relatively undervalued areas of the market and are well positioned to benefit from the ongoing expansion in real economic activity in the US. Furthermore, they have historically performed particularly well in this sort of market choppiness that we're currently seeing. We also retain our tilt towards emerging markets, which look cheap and where profits remain robust. The third theme is mind the debt iceberg. Public finances are deteriorating as debt levels rise. We expect this trend to continue as governments spend to stimulate their economies, defense budgets increase, and interest rates remain elevated. In light of this, we are becoming increasingly selective with who we lend to and for how long. We remain focused on shorter dated developed market government bonds with a preference for US and UK over Europe. By contrast, we like emerging market government bonds, which pay an attractive level of income despite the fact that public sector spending is contained. Finally, we reduced our exposure to the US dollar. If you'd like more detail on our outlook, portfolio changes, or performance, check out the latest quarterly update. Thanks for watching.